Hello, fellow and future investors. I'm Ben, and this is GVD Investing, where I break down the latest stock market news, analyze stocks, teach the basics of investing, and share my personal investment journey in hopes of making us all better investors. Thank you for tuning in. Your support is greatly appreciated. If you're new to the channel and you like what you see, please like and subscribe to be notified when new videos are released. In today's video, the first of a new series I will be releasing called Investing for Beginners, I will go over some of the most common terms, words, and acronyms used in the investing world. When you're just getting started investing, there's a ton of new terminology that can be a little daunting to understand at first. What's a dividend? What is the market cap? PE ratio, PS ratio, EPS, IPO, SPAC. These are all terms you may have never heard before. I know I hadn't when I started investing. In this video, I hope to explain those concepts in the quickest and simplest way, make it easier for you to understand and easy to reference. Let's get to it. Okay, so the first and most important concept to understand when you start investing is probably the market cap or market capitalization. This is simply the current market value of a corporation. To figure this out, you multiply the current stock price by the number of shares the company has issued to the public, called shares outstanding. Without digging into financials, it's the quickest way to get an idea of how expensive a company is in comparison to their competition, the market as a whole, and other companies in similar phases of growth. You will often hear terms like large cap, mid cap, or small cap when referring to a corporation. These are really just superficial dividing lines used by investors to categorize companies by their market cap. Large cap is typically any business valued at over $10 billion. Mid cap companies are usually valued between $2 billion and $10 billion, while small cap companies are valued below $2 billion. Some people might even refer to companies under $300 million as microcap or penny stocks. Historically, large corporations tend to grow more slowly than small caps, but companies like Apple, Google, Amazon, Facebook, Microsoft, Netflix, and Tesla are showing that isn't always the case. That said, large caps tend to be more mature companies, and so are typically less volatile during rough markets. Although, once again, in 2020, many large cap corporations got absolutely crushed by the pandemic and resulting economic conditions. Sometimes, the bigger they are, the harder they fall. Just take a look at the cruise line industry, retail, or even some of the big banks. Their returns have been dwarfed by some of the riskier small and mid cap stocks. Historically, small and mid caps, even though more affordable, have proven to be more volatile and hence riskier investments. That said, just because it's a small or mid cap company doesn't always mean it is a risky investment, as many up and coming companies carry very little risk and solid financials. If you do your research, you will find that the potential upside of some of the small and mid cap companies far outweighs the downside risk. As with any business, the risk is always bankruptcy. With small caps, this risk is often greater given the lack of a track record when it comes to implementing the business model, limited or no revenue, and typically limited cash flow or profitability until the business is established. If a small cap company is carrying a lot of debt, the risk of bankruptcy is high. However, large caps can be just as risky as witnessed in recent years by blue chip companies like Boeing, Carnival Cruise Lines, General Electric, General Motors, Ford, and JCPenney. Whether it's a small cap, mid cap, or large cap company, the only way to truly understand whether a company is under, over, or fairly priced is by taking a look at some other key metrics and eventually their financial statements. The first metric I always like to take a look at when looking into a company is the price to sales ratio, or PS ratio. This is simply the current market cap divided by the last 12 months of revenue. For example, if a company has a market cap of $100 billion and had sales of $10 billion in the last year, their price to sales ratio would be 10. Or in other words, at the current stock price, you are paying 10 times what the company makes in revenue every year to own shares in that company. The higher the price to sales, the more of a premium you are paying for those shares. Historic average price to sales ratio will vary from year to year, company to company, industry to industry, or whether it's a dividend stock or a growth stock. But this metric gives you a quick understanding of how a corporation is currently being valued in comparison to the competitors in the market as a whole. I find this to be the most versatile metric to use, as it can be used to evaluate any company that has revenue, which covers the majority of the stocks in the market, unless you're getting into really small startup companies or penny stocks that don't have any sales yet. For the most part, Growth stocks typically warrant a higher price of sales because they have more excitement around the company and are in a higher growth phase that can provide shareholders larger returns that some of the large cap companies simply can't. Typically, it is much less likely for a large cap company to 10x over a short period of time than it is for a smaller, rapidly growing company. For a company like Apple to 10x, at this point, that would mean they have to hit a $20 trillion market cap. That would be quite the feat. However, for a company valued at $1 billion, they would only need to hit a $10 billion market cap to 10x, which in today's world is accomplished by some companies that barely even have revenue. The more hype around a stock, the higher the price to sales ratio will be. Oftentimes, large cap, blue chip, dividend paying companies offer more stability, but less in terms of capital gains, so they command a lower price to sales. It's not uncommon to see large cap companies with price to sales lower than 5 or even close to 1, whereas hotter growth stocks can easily command a price to sales well over 10, often into the mid-teens or low 20s, and sometimes even higher. The higher the price to sales ratio, the more expensive the stock. You can tell if a stock is currently overpriced by taking a look at other companies in the same industry and comparing their price to sales ratios. If the PS ratio is really high in comparison to their competition, then the stock is likely overpriced. On the other hand, if the price to sales is far lower than those other stocks, then the company you are looking at is probably underpriced. You can even use this to compare other growth companies from other industries and the overall market. Anything over 20 would have to be considered fairly overpriced, regardless of the industry. Many value investors will consider a price to sales between 10 and 20 really high given historical price to sales ratios, but given the shift in the market in the last decade towards higher growth companies, partially due to the advent of more retail investors now investing using commission-free trading apps, I think trends are changing, and for high growth potential companies, it will become the norm to see higher average price to sales ratios. That said, in our current market, there are a few stocks that have PS ratios in the thousands, which, in my opinion, is absolutely insane. Okay, so, you still with me? Now that you have a better understanding of market cap and price to sales, another one of the most commonly used metrics you will hear used by investors and analysts is the PE, or price to earnings ratio. To have a PE ratio, a company will need to be profitable, as the PE is calculated by taking the current share price and dividing it by the earnings per share, or EPS. We will discuss that in a second. For example, let's say shares of the company you are looking at are currently selling for $20 a share, and the company has an EPS of $4. This would mean the company's PE ratio would be 5. The PE ratio is most commonly used for evaluating larger, more established businesses, especially dividend-paying companies, and much like price to sales, price to earnings can be used to determine whether a company's stock price is overvalued or undervalued, and can reveal how a stock's valuation compares to its industry group or a benchmark like the S&P 500 index. Also, and similar to price to sales once again, companies that grow faster than average typically warrant higher price to earnings multiples, such as technology companies. A higher price to earnings ratio shows that investors are willing to pay a higher share price today because of growth expectations in the future. The average price to earnings for the S&P 500 has historically ranged from 13 to 15. For example, a company with a current price to earnings of 25 trades at 25 times earnings. The high multiple indicates that investors expect higher growth from the company compared to the overall market. However, a high price to earnings does not necessarily mean a stock is overpriced. Any price to earnings ratio needs to be compared against competitors in the same industry, the current average PE of the major indexes, and the track record of the company's price to earnings in previous years. Trailing PE is for the past 12 months, whereas forward PE is what is expected to be a year from now. The only real difference between price to sales and price to earnings is that one is calculated based on revenue, or sales, and one is calculated using profit, or earnings. Both can be equally effective at determining whether a stock is fairly valued and for predicting the future performance of that stock. But personally, I prefer to use price to sales, as I feel it's easier to predict future revenue than future earnings, and it can be used for companies that aren't profitable yet. Now, try not to get overwhelmed by all of this information. I have left timestamps down in the description so you can easily refer to each section at any time, and all of these concepts are explained in greater detail on Investopedia or other investing websites. At first it seems like a lot to learn, but these terms and concepts quickly become second nature. To fully understand price to earnings, you will also need to understand earnings per share, or EPS. This is easy to find on any of the financial websites, so calculations are rarely necessary, but it's good to understand how they arrive at those numbers. EPS is calculated as a company's profit divided by the total outstanding shares. For example, if a company made $10 million profit and has 1 million shares issued to the public, their earnings per share would be $10, meaning they made $10 for every share outstanding. The higher a company's EPS, the more profitable it is considered to be. The earnings per share metric is one of the most important variables in determining a share's price. It is also one of the two components used to calculate the PE ratio, as the E in PE refers to earnings per share. As explained previously, by dividing a company's share price by its earnings per share, an investor can see the value of a stock in terms of how much the market is willing to pay for each dollar of earnings. EPS is one of the many indicators you could use to pick stocks, and a favorite for value or Buffett-style investors. Investors not only use the PE ratio and EPS to determine a stock's market value, but also in determining future earnings growth. For example, if earnings are expected to rise, investors might expect the company to increase its dividend as a result. Higher earnings and rising dividends, or more free cash flow available to fuel faster growth, typically lead to a higher stock price. Once a company has earnings, it can either use those earnings to fund future growth, strengthen the balance sheet, or to reward shareholders by way of a dividend. A dividend is simply the distribution of some of a company's earnings to its shareholders in cash. Or in other words, a company will pay you a percentage of what you invest as a reward or thank you for owning and holding their stock. For example, if you invested $1,000 into a company that pays a 4% dividend, you would be paid $40 a year by that company. If the dividend is paid out quarterly, you would receive a payment of $10 every quarter on that $1,000 investment. Good companies often increase their dividend over time, and some have even been increasing their dividends for over 50 years. These are called dividend kings. Shareholders of dividend-paying companies are eligible as long as they own the stock before the ex-dividend date, which is easy to find on Yahoo Finance or other brokerage sites, and simply means the day you must own the stock by to be eligible to collect the upcoming dividend. If you miss that date, you will be paid when the next dividend is paid out. Dividends are typically paid out as cash, or sometimes, but very rarely, in the form of additional stock. Dividends usually originate from a company's net profits. While the major portion of the profits are kept within the company as retained earnings, which represents money to be used for the company's ongoing and future business activities, the remainder can be allocated to the shareholders as a dividend. At times, companies may still make dividend payments even when they don't make suitable profits. They may do so to maintain their established track record of making regular dividend payments. Under normal circumstances, dividends are paid routinely on a monthly, quarterly, or annual basis depending on the company. However, in times of financial crisis, dividends can be cut temporarily or sometimes permanently, as we've witnessed this year by countless companies in response to the economic situation caused by the global pandemic. If a company has a long history of dividend payments, a reduction of the dividend amount or its elimination may signal to investors that the company is in trouble. Larger, more established companies with more predictable profits are often the best dividend payers. These companies tend to issue regular dividends because they seek to maximize shareholder wealth in ways aside from normal growth. For example, REITs, or real estate investment trusts, are historically top dividend payers since their designation requires distributions to shareholders, often monthly. Startups and other high-growth companies, such as those in the technology, EV, and biotech sectors, may not offer regular dividends because these companies may be in the early stages of development and may incur high costs, as well as losses attributed to research and development, business expansion, and operational activities. They may not have sufficient funds to issue dividends. Even profit-making early to mid-stage companies avoid making dividend payments if they are aiming for higher than average growth and expansion and want to invest their profits back into their business rather than paying dividends. Dividends are often sought after by shareholders because they are treated as tax-free, passive income for shareholders in many countries, whereas capital gains realized through the sale of a share whose price has increased is usually considered taxable income, unless investing into a tax-free savings account like we have here in Canada. Dividends allow you to make money as a shareholder without having to sell any shares or needing to time the market. This gives you the liberty to do what you want with the newfound cash. You can then reinvest those dividends. If you do this automatically, this is called a DRIP, reaping higher returns and unlocking the power of compounding interest, or to spend on leisure, travel, bills, or other expenses. Many retirees rely on dividends to fund their retirement. If you're planning to live or retire on the income from your dividends, and knowing that dividends can be cut during times of economic uncertainty, it is essential to understand how to determine whether a dividend is secure or it is likely to be cut in the near future. Figuring that out is not as hard as it might sound, and you don't have to buy a crystal ball to try to predict the future. Luckily, there is another metric called the payout ratio. This is extremely easy to find online and simply means the percentage of the company's earnings that are being paid out in dividend payments to their shareholders. The payout ratio is a key financial metric used to determine the sustainability of a company's dividend payment. For example, let's assume company ABC has earnings per share of $1 and pays dividends per share of 50 cents. In this scenario, the payout ratio would be 50%, a relatively safe payout ratio. That means the company is only paying half of their earnings to shareholders in dividends, while still having the other 50% to invest in growing the business. Let's further assume that company XYZ has earnings per share of $2 and dividends per share of $1.50. In this scenario, the payout ratio is 75%. Comparatively speaking, company ABC pays out a smaller percentage of its earnings to its shareholders as dividends, giving it a more sustainable payout ratio than company XYZ. More often than not, the higher the payout ratio, the less sustainable the dividend is. If a company has a payout ratio over 100%, that means the company is likely taking on debt to pay out its dividend, which is not sustainable, and as a result, the dividend is at serious risk of being reduced or cut completely. If debt is being used to cover the dividend payments, this can also lead to further financial issues for the business, sometimes even bankruptcy. So that does it for the key metrics you should get to know as a new investor and how to use them to analyze stocks. There's always more to learn and more information you can gather, but if you understand those key concepts, you can surely get started picking stocks for your portfolio. Let's do a real quick recap before closing out the video. Market cap is the current market value of a company based on the current stock price times the number of shares outstanding. Price to sales is the market cap divided by the trailing 12 months of revenue. Price to earnings is the current stock price divided by the earnings per share. Both of those metrics can be used to understand whether or not a stock is fairly priced and to forecast where a stock will go in the future. Earnings per share is the amount of profit, earnings, a company made divided by the number of shares outstanding. Once a company has earnings, they can decide to use a percentage of that to reward shareholders for holding their stock, known as a dividend. A dividend is a monthly, quarterly, or annual cash payment from a company to their shareholders. The dividend yield is the percent you are earning on your investment. This may or may not increase or decrease over time. The payout ratio is the percentage of a company's earnings that are being paid to shareholders in dividends, and a DRIP, dividend reinvestment plan, is when you decide to have your dividends automatically reinvested back into buying more shares of that company. If you're a sports fan, all of these numbers and abbreviations are no harder to understand than the key stats in your favorite sport. If you love baseball, it's like RBIs, ERA, and Ks. If you're a hockey fan, it's like goals against average, save percentage, goals, assists, and points. If you're a basketball fan, it's like field goals made, field goals attempted, or threes per game. It all may seem a little confusing at first, but once you understand what the abbreviations mean and can look at the stats like you do for any sport, it's really not any different. The only difference is you are evaluating companies instead of athletes. Don't get intimidated. In my relatively short time investing, I have had many friends, family, and people in DMs ask me what a few other abbreviations mean, so we'll just rip through those quickly, as they aren't nearly as important when you just get started investing. Okay, so the first one I get asked about a fair amount would be EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. In my opinion, this is a totally irrelevant stat. It would be like you telling people how much money you have in the bank before you've paid any taxes, bills, or debt payments. Sure, it was nice to have that money and it was income, but it's not really yours at the end of the day and certainly not profit. Stock split. A split is when a company decides, for various reasons, to split their stock. This doesn't change the valuation of the company at all. It just splits the current share price into smaller pieces of the same pie, even though it does make the purchase price lower now that it's a smaller piece of that pie. So, if shares of a company are selling for $2,500, and the company decides to do a 1-for-5 split, you would end up with 5 shares of that company, but each share would only be worth $500. Same price, same pie, just divided by 5. If they split by 10, you would have 10 shares for each one you owned prior to the split, but they would be worth $250 per share. It's really simple math. Nothing changes fundamentally. Sometimes struggling companies will decide to do a reverse split to reduce the number of shares available or to increase their stock price to meet index thresholds. This is the exact same idea but in reverse. Reverse splits are usually a sign that things aren't going well for the business. IPO. An IPO is the initial public offering for a company or the first time the stock of a company is available to be traded on a public stock exchange. IPOs often have lots of hype around them and cause their valuations to become wildly overpriced. In the words of the great author Robert Kiyosaki, he believes IPO stands for "it's probably overpriced." Companies will often have tons of hype surrounding them right as the stock becomes available to the public, but in most cases, that tends to die down after the initial hysteria wears off. SPAC. SPAC is a special purpose acquisition company with no commercial operations that is formed strictly to raise capital through an IPO for the purpose of acquiring an existing company. Also known as blank check companies, SPACs have been around for decades. In recent years, they've become more popular, attracting big name underwriters and investors and raising a record amount of IPO money in 2019. In 2020, as of the beginning of August, more than 50 SPACs had been formed in the US, which had raised some $21.5 billion. SPACs are generally formed by investors or sponsors with expertise in a particular industry or business sector, with the intention of pursuing deals in that area. In creating a SPAC, the founders sometimes have at least one acquisition target in mind, but they don't identify that target to avoid extensive disclosures during the IPO process. This is why they are called blank check companies. IPO investors have no idea what company they ultimately will be investing in. Buying shares of the SPAC before the merger has gone through is only for investors with a high risk tolerance, as until the merger is approved, there is no guarantee that the company that is proposed to be acquired will be taken public. Some SPACs fail to materialize, and the investor is left with shares of a shell company with no real commercial operations. These are high risk, high reward investments. Which leads to the last abbreviation for this episode, and one I love being asked what it means: the dreaded FOMO. So what is FOMO? FOMO is the fear of missing out. That feeling you get when you hear of a stock on its way to the moon while you sit watching through a telescope. You want to be on that rocket too. Everyone on that rocket is rolling in the dough. It makes you jealous. What if I was on that rocket? I missed my chance. There will never be another rocket like that one. But then boom! That rocket explodes and you're happy as hell you weren't on it. The moral to that story is there will always be more rockets in the future, and hopefully the one you find will be even better than that one. There are thousands of stocks available, and there will always be companies growing exponentially. Just because you missed this one isn't the end of the world. Just wait patiently for the next takeoff. If you miss that one, try again. There will always be another opportunity. So I think that's a wrap, ladies and gents. If you've made it this far, thank you so much for sticking with me this whole time. Please tickle that like button. And if you want to follow the journey and be notified of future videos, please smush that subscribe button. Thank you very much. Until next time, be safe, wear a mask, and invest wisely.